Hello and welcome to Livewire Markets C-Suite reporting coverage. My name is Anna Dadich. Today I'm joined by Andrew Alcock, CEO of HUB24. He's going to be talking to us about the company's recent results. Hi Andrew, thanks for joining me.
Hi Anna, great to be here. Thank you for having us.
What are the most important numbers investors need to be aware of after today's results, and were there any surprises?
If you think about the business and what drives value in the business, certainly the funds under administration and the net inflows are key drivers of that. So having the $19.8 billion of net flows and the funds under administration getting to where they got to, I think it was 112.7 at year end, but now at 118 in mid-August. With market growth, but with inflows, we're continuing to run with momentum. Apart from that, all the financial numbers are pretty healthy. If you're thinking about other numbers in terms of financials, our stat MPAC's up 68%, underlying up in the 40s. Revenue and EBITDA across the board is really, really positive. Interestingly, our tech solutions business is also up 9%, and that's a mature business that we hope to leverage in building an ecosystem. So one more lead indicator that we're fascinated by is this 500 odd advisors, or 527 new advisors using the platform in the last 12 months, which really spells out the opportunity we deliver, and we're on our game with servicing and looking after customers' advisors. That's a great sign for further momentum.
You've just mentioned you've had a record year of net flows for FY25.
Yep.
How confident are you that organic flows can keep breaking records without the one-offs?
Hey, look, it's not been done, but I think if you look at the lead indicators, it's certainly possible. I think they've got 527 new advisors in the last 12 months. That's a record for us. Since FY21, we haven't had that many new advisors. That's a lead indicator for people choosing to use the platform. Our momentum in the first part of this year has been great as well. So, we'll wait and see. We're certainly targeting a FUA range between now and FY27, which would mean you have to get between 14 and $18 billion a year. So certainly replicating the 15.8 organic is possible in that range.
April's market wobble barely dented your inflows as well. How are you able to weather risk-off periods?
Look, I think it's about advice and the real need and the use case for platforms. You've got intergenerational wealth transfer, you've got people aging, looking at starting pensions, and really what's happened in Australia, advisors and their clients have become quite resilient about those sort of periods. They're not stock trading. So risk on, risk off, yes, you might adjust your asset allocation, but it is for the long term. So it's a fairly resilient business model for us. You've got mandated superannuation, that doesn't change. You've got people retiring and so forth. So the use case is there that creates resilience in our business, which means you don't see as much volatility when you see the macro events.
You've now overtaken your competitors in custodial FUA. What's your strategy to hold and expand that lead in the market?
Hey, look, we have to work hard at that, but I think the reason we've done that is our consistency in looking after customers. We really believe in unlocking value and helping Aussies get a better deal with their platforms and working with advisors. So the strategy is doing more of the same, to keep investing in building better features and products, which we've done. We've launched some new features and products this year to keep making sure we're on the game and on the money with looking after client expectations, great customer service, great NPS scores. And so it's more of the same, which we've done for a few years now, and hopefully you'll see that trajectory continue. So we've seen us approaching that trend where we might overtake, and we hope to keep doing that.
You mentioned features and product changes. So what tech or product developments for the platform are on the horizon that investors should know about?
We've just launched in the last few weeks a private invest offer, which is a wholesale offer, which makes it easier for wholesale investors and advisors to jump on in. Makes it easier to get access to a broader universe. It gives them more flexibility and some easier disclosure. And that's in its early days. We've also launched a new reporting tool called Engage, which takes data from multiple places and allows advisors to do some of the things that perhaps they didn't do with platforms before, to do portfolio reporting and have an engaging conversation about client outcomes in their own language. It really is revolutionary tech. We'll keep building on those things, but they're examples of us taking our footprint, which is a platform business, and some technology businesses, being Class and now Infinity and MyProsperity, and building out an ecosystem, which is very different to platform does this. It's about saying, hey, how can we work across the wealth value chain and the wealth ecosystem to make it easier and safer for customers and advisors to get the job done?
What's the next phase in your market share strategy, and how high do you think HUB24's share can go?
I'll answer that bit first. Look, I think if you look at the market traditionally, there have been participants in the platform industry who've had up to 20% market share. We're at 9% or just under 9% right now. So there's no reason why we can't get to those sort of levels over time, and it does take time. Having said that, we've grown our market share from 4% to 9% in 4 years. And so it's quite possible we keep going in that direction. There are less participants today, and certainly we have market-leading functionality where we're ahead by a long way in the functionality ratings on the platform. So for us, the strategy to that is stick to your knitting, keep looking after your customers, keep finding better ways to do things, to make things more efficient, keep finding the answers to the problems we've got in Australia, which is there's a lack of investment in technology that actually can make this a more streamlined process. Advisors spend so much time gathering information, so much time producing review documents, so much time delivering advice. As a platform that sits on lots of data and a tech provider, hopefully we can make that easier by building out that ecosystem. Those strategies are already paying yields for HUB24 in terms of the advocacy and the growth in our business.
So how do you balance the market's high expectations for FY26 with the need to reinvest for sustainable growth?
We've been doing that all along as well, but there are high expectations, and certainly we think about that. We think about the accelerator and the brake in the business, the brakes in the business, if you like. So we had a 3.8% increase in EBITDA margin, or underlying EBITDA margin this year. That's a large increase. But that gets faster and slower, the expansion of margin, depending on what we're investing in. So if there's opportunities to make a difference, we're certainly not shy about making an investment, which slows down that profitability emergence over time. But we've done that for 12 years now. So we, really thinking about how you deliver better shareholder returns at the same time as investing, and trying to keep that together in a consistent pattern is one of our goals. But we're not shy to actually invest more if there's a bigger opportunity, which of course slows that down. So it is a balancing act. It's about looking at the opportunity and how we can make a difference, and thinking about that for the longer term.
Thank you so much, Andrew, for sharing your insights about HUB24 and for the results today.
Pleasure. Good to see you.
If you enjoyed that interview, give it a like and stay tuned for more coverage on reporting season.